We're jumping straight into Ciena today. Everyone is watching the price action, but the real story is the explosion in AI connectivity and hyperscaler demand.
Exactly. You're tuned into the Easy Money Show where we make sense of the market's biggest moves. I'm glad you're with us.
And before we really get into the absolute roller coaster the stock has been on lately, I want to remind you to subscribe and hit the like button. By doing that, you're making sure we can keep simplifying the market for you, finding the actual signal in all of this daily noise.
Yeah, you definitely do not want to miss the deep insights we have coming up.
Right, because today we are taking a massive stack of recent earnings reports, equity research notes, industry white papers, and we are just extracting the critical insights. We want to figure out what is actually happening beneath the surface of this artificial intelligence boom.
It is genuinely fascinating right now.
It really is. I mean, we have a company here that is quite literally building the physical backbone of the AI revolution, putting up numbers that are just staggering. And yet the market reaction has been wildly disconnected from what you might logically expect.
Yeah, it's a classic case of the market's immediate sort of emotional reaction clashing violently with the underlying fundamental reality.
Completely violently.
Right. Because when you look at the raw data in these research notes, the demand for AI infrastructure isn't just some hypothetical projection for the year 2030 anymore.
No, not at all.
It is showing up right now
Yeah.
in hard dollars and cents right on the balance sheets of the companies laying down the physical fiber and optical connections.
I think people get so caught up in the software side of things, they forget that the cloud is still entirely physical.
Exactly. The cloud is just a building full of computers.
Let's break that down even further, because the numbers from their record fiscal first quarter of 2026 are just massive. But instead of me just rattling off the spreadsheet, walk us through the actual scale of this jump. How big of a leap are we talking about here?
Well, we are talking about $1.43 billion in top-line revenue.
Wow.
For a single quarter. That is a 33% increase year over year from their previous $1.07 billion.
And in a hardware space, a physical infrastructure space, seeing a 33% jump for a company of this size is highly unusual.
It's extremely unusual. Hardware doesn't typically scale like software. You have to physically manufacture, ship, and install these units. It takes time.
Right.
And the main engine behind this unprecedented growth is their optical networking division. That segment alone leaps by 40.5% to hit $1.02 billion on its own.
I want to pause on that 40.5% jump in optical networking because I think it helps to visualize what is actually happening on the ground here. When we talk about optical networking, we aren't talking about your home Wi-Fi router.
No, definitely not.
We are talking about sprawling data center campuses. Places like Loudoun County, Virginia, where you have dozens of warehouse-sized buildings just packed to the brim with servers.
Right, the hyperscalers.
Exactly, the hyperscalers. And for those servers to act as one unified AI brain, they have to send unimaginable amounts of data back and forth using pulses of light through physical glass tubes.
Yeah, fiber optics.
Right. And these vast cloud providers running these AI models, they're realizing they have a physical bottleneck. If the light can't travel fast enough, their multi-billion-dollar AI chips just sit idle.
That is precisely the issue. We spend so much time talking about the brains of AI, the large language models, and the graphics processing units. But none of those brains can function at scale without a world-class nervous system.
A nervous system, I like that.
Yeah, what optical networking does is act as the high-speed plumbing of the digital age. When you see a specific division jumping 40.5%, you are seeing the direct result of big tech companies aggressively spending to widen the pipes so their expensive AI brains don't starve for data.
And that ravenous demand is translating straight to the bottom line, which is what really caught my eye here. Their profitability metrics are just accelerating.
They really are.
Their adjusted earnings per share skyrocketed by 111% to $1.35. And for the listeners, when we look at their GAAP net income, which is the strict standard accounting measure without any corporate adjustments, it jumped from $44.6 million all the way up to $150.3 million.
It's a massive leap.
It is, but here's the part that I want you to explain, because this seems almost like magic in a high inflation environment. They managed to do all of this while keeping their gross margins completely stable at 43.8%.
Yeah.
How does a company maintain stable margins when the costs of materials, labor, and research are all theoretically going up?
That stable 43.8% gross margin is arguably the most vital piece of data in the entire report. Maintaining margins while scaling revenue that aggressively is the holy grail for a physical infrastructure company.
Because it shows pricing power.
Exactly. It tells us a story about profound pricing power. It means Ciena isn't just discounting their products to win market share in a crowded field. They are selling highly premium equipment at premium prices because their customers absolutely have to have it.
Regardless of the cost.
Right. The hyperscalers are essentially in an arms race right now, and Ciena is supplying the most advanced weaponry. They can pass any rising component costs directly onto the customer because the customer has no choice but to pay up.
That brings us to their future guidance, which management raised significantly. For the full year of 2026, they are now projecting revenue between $5.9 billion and $6.3 billion.
Which is phenomenal growth.
Yeah, at the midpoint of that range, you're looking at 28% growth. And the bedrock of that confidence is a multi-year record backlog that stretches all the way into 2027. Management noted they have a substantial line out the door of customers waiting for this equipment.
A very long line.
But I want to play devil's advocate here and push back on that a bit. Isn't a backlog spanning all the way into 2027 actually a massive risk in the tech sector?
Also,
Well, technology moves at lightning speed. By 2027, won't the equipment they are ordering today be obsolete? How do we know these hyperscalers won't just cancel their orders if better tech comes along next year?
that is a highly perceptive question, and it gets to the core of how enterprise hardware contracts actually function. In the consumer world, yes, you might cancel a phone pre-order if a better one is announced.
Right.
But in the hyperscaler world, these are legally binding, ironclad capital expenditure commitments. Furthermore, the development cycles for optical hardware are incredibly complex and synchronized with the actual data center build schedules.
So the buildings themselves are designed around the tech.
Exactly. The cloud providers are designing their physical buildings around the exact specifications of Ciena's upcoming hardware. Canceling an order doesn't just mean waiting for a new router, it means halting a multi-billion-dollar facility build-out.
Wow, okay.
So that backlog provides a robust safety net. It completely insulates them from month-to-month fluctuations in the broader economy.
So it's locked in. I get that the demand is there and the pipeline is secure, but surely competitors like Nokia or Huawei are seeing the exact same AI boom. Why is this hyperscaler cash flowing so heavily into Ciena's pockets specifically? What is the competitive moat here?
It comes down to their deeply proprietary technology. We're talking about specific products like the Wave server, the 6500 RLS, and their highly anticipated brand new Vista 200 6.4T CPX.
And to ground that jargon for a second, the 6.4T means it can process 6.4 terabits of data per second.
Correct. And these aren't just off-the-shelf components you can swap out. They are highly specialized, custom-built solutions designed specifically for the extreme, sustained workloads of AI data centers.
And once you install a system that complex, it becomes the foundation of the entire facility, right?
Precisely. That specialization creates immense switching costs. Imagine a cloud provider has integrated this proprietary architecture into the core of their global network. To rip that out and replace it with a competitor's equipment would be like trying to replace the concrete foundation of a skyscraper.
While people are still working inside the offices above.
Exactly. The downtime, the software integration headaches, the risk of catastrophic data loss, it's simply not worth the operational risk. Once they are integrated into these highly lucrative AI monetization pipelines, they are exceptionally sticky. It heavily protects their market share against those global competitors you mentioned.
And all of this fundamental business strength is clearly reflected in their financial health. They are sitting on a rock-solid balance sheet with $1.37 billion in cash, cash equivalents, and investments.
Very strong liquidity.
Yeah, their debt is very manageable, consisting of a $1.15 billion term loan and $400 million in senior notes. But the cash generation is what really stands out to me. Their operating cash flow doubled to $227.6 million.
That operating cash flow is vital. It is pure, unadulterated cash being generated by the day-to-day business operations, which gives them substantial flexibility. They even have a $300 million revolving credit facility that they haven't had to touch.
Right. And what they're choosing to do with that free cash flow is very telling. They just funded and completed a $410 million share repurchase program.
That is a massive signal.
It is. When a management team is buying back its own stock to that tune, it signals profound insider confidence. They're essentially looking at the broader market, looking at their own 2027 backlog and saying, we believe our own stock is the absolute best investment we can make with this cash right now.
It's a powerful statement of capital allocation. It tells you that despite whatever short-term noise is happening on the trading floor, The people who actually see the daily order flow and sign the customer contracts believe the company is fundamentally mispriced relative to its long-term potential.
Looking at the flip side,
Mhm.
we have to address the bizarre reality of what actually happened to the stock price.
Yeah, the post-earnings reaction.
Exactly. Despite everything we just discussed, the record top-line revenue, doubling cash flow, huge earnings beats, raised full-year guidance, and massive share buybacks, the stock fell off a cliff after earnings.
It was a brutal drop.
We saw a sudden, violent drop of 15.6% to 20%. For a lot of the retail investors tuning in, this was incredibly confusing. Why would a stock get punished so heavily on what looks, on paper, like a flawless quarterly report?
This raises a crucial lesson about market mechanics, specifically the tension between expectations and reality. In the current environment, anything tangentially associated with the AI infrastructure boom has been priced for absolute, untouchable perfection.
Perfection is hard to beat.
Right. And while they undeniably raised their full-year guidance, a certain segment of institutional investors perceived that guidance as slightly soft. It didn't meet the wildest whisper numbers.
And whisper numbers are those unofficial sky-high expectations that get passed around Wall Street trading desks before an earnings report.
Exactly.
And we also have to factor in the derivatives market, right? Because the options flow leading into this earnings event had implied a monumental move in the stock price. Options traders were placing heavy bets on extreme volatility.
Massive bets.
So when the guidance was seen as just great instead of otherworldly, you had a sudden rush for the exits from short-term speculators.
That is exactly what happened. When a stock is caught in a momentum trade driven by short-term options contracts, even a fantastic fundamental beat can lead to a violent sell-off if it doesn't shatter those extreme derivative-driven expectations. The underlying business is completely fine, but the short-term trading vehicle experiences a crash.
But beyond the short-term trading dynamics, there is a very real structural fundamental risk here that we have to talk about, and that is customer concentration.
Yes, the hyperscaler risk.
I like to think of it like having 3 giant whales in your fishing boat. Sure, you caught the biggest fish in the ocean, but if just one of those whales decides to shift its weight, the entire boat is going to rock violently.
That is the perfect analogy, and it is the double-edged sword of supplying the hyperscalers. Yes, these cloud providers have bottomless pockets and are spending billions, but it also means their financial destiny is heavily tied to just a handful of corporate entities.
It's a huge vulnerability.
It is. If one or two of these behemoths suddenly decide to delay a data center project, or if they shift their capital expenditure strategy to focus on a different kind of hardware, it has an outsized immediate impact on the bottom line. Having your performance tied so tightly to a few key players amplifies your inherent volatility.
And while the revenue is booming, the costs to stay at the absolute cutting edge are also rising. The research shows that R&D, along with overall operating expenses, have increased by 11.5% to $436.1 million.
Engineering isn't cheap.
No, you obviously have to spend money to engineer something as complex as the Vesta 200, but that is a significant increase in overhead. Combine that with the fact that there have been some insider selling signals recently, and it definitely creates a narrative that gives some cautious investors pause.
It does, though I would contextualize both of those points. In the optical networking space, if you stop aggressively funding your R&D, you become obsolete in a matter of months, not years. It is a necessary survival expense.
That makes sense.
And as for the insider selling, executives sell shares for a myriad of reasons. Buying real estate, diversifying their personal portfolios, paying tax obligations. What matters more is how the company manages those rising operational expenses.
That's a fair point. And to manage those expenses, they are sitting on a current ratio of 2.73. For anyone unfamiliar with that metric, the current ratio measures a company's ability to pay its short-term obligations.
It's a great liquidity measure.
Yeah, so a ratio of 2.73 means they have nearly $3 in highly liquid assets for every $1 of short-term liabilities they owe. That is a fortress of a buffer.
Precisely. A current ratio of 2.73 means they have a sprawling, rainy day fund. Even if the broader economy hits a sudden speed bump, or if one of those hyperscaler whales delays an order, they have the liquidity to keep the lights on, keep paying their world-class engineers, and keep innovating.
Without having to take on toxic, high-interest debt or dilute their shareholders by issuing new stock in a panic. So, with this intense tug-of-war between stellar fundamentals and a brutal post-earnings chart, what should you actually be watching right now? Let's look at the Wall Street reactions, because the heavy hitters are absolutely making moves in the wake of that drop.
They certainly are.
Following the sell-off, Bank of America actually upgraded the stock. They pointed directly to the ongoing surge in cloud spending as the primary catalyst that the market is ignoring. Meanwhile, UBS came in and raised their price target significantly, pushing it up to $285.
What is particularly fascinating here is the terminology being thrown around by these institutional analysts. In the research notes, you're hearing this referred to heavily as an ugly dip entry point.
The smart money loves an ugly dip.
They do. They often look for exactly this kind of setup, a fundamentally robust company that gets unfairly punished due to short-term options volatility or misaligned whisper numbers. They view the post-earnings drop not as a structural failure of the business model, but as a temporary pricing inefficiency to take advantage of.
And the technical setup is incredibly compelling right now if you follow those kinds of metrics. Despite the harsh drop, the stock still perfectly aligns with Mark Minervini's technical uptrend rules.
Which is key for momentum traders.
Right. For those who aren't staring at technical charts all day, Minervini's rules are a specific set of criteria that look for established, long-term price uptrends backed by accelerating fundamentals. It's a template designed to weed out flashes in the pan and identify sustained growth momentum.
And the fact that it still meets those criteria suggests that the core growth trend remains totally intact.
Exactly.
It's a classic tension between the fundamental story and the immediate technical chart. The fundamentals are screaming that the backlog is full and the hyperscalers are deploying capital. The short-term technicals took a hit, but the longer-term moving averages act as an anchor.
It provides support.
Yeah, this is exactly the kind of setup that attracts quiet institutional accumulation, which we are likely going to see confirmed when the next round of 13F filings come out, which is when the big hedge funds and asset managers are required by the SEC to publicly reveal what stocks they've been accumulating.
So if you are tracking this story, grab your calendar. We have some major triggers coming up over the next 30 to 90 days that you need to be aware of. First and foremost, you need to circle late May or early June for their fiscal Q2 2026 earnings report.
That is going to be a huge day.
Right now, the consensus estimates from analysts are sitting at roughly $1.5 billion in revenue for the quarter. That report is going to be the ultimate proving ground to see if this AI momentum is accelerating exactly the way management promised, or if the hyperscalers are tapping the brakes.
Alongside that earnings print, keep a very close eye on the major tech and telecommunications industry conferences over the next couple of months. What you want to listen for are specific updates on the adoption rates of the new Vesta 200 platform.
You want to see who's actually buying it.
Exactly. If we start hearing the major cloud providers publicly referencing this technology in their own presentations, or if the company hosts an investor day to showcase real-world data center deployments, that could act as a substantial catalyst to completely reset the market's expectations.
You also want to keep your ear to the ground regarding speculative M&A chatter, mergers and acquisitions in the optical routing space. While it is just industry rumors right now, history shows that as a landscape like AI infrastructure consolidates, companies possessing proprietary, irreplaceable tech often become the center of some very interesting high-level buyout conversations.
It wouldn't be surprising at all.
And finally, you have to zoom out and watch the broader macroeconomic trends. The market is highly anticipating interest rate cuts later this year.
That macroeconomic point cannot be overstated. Interest rates directly affect the weighted average cost of capital for these massive tech companies.
It dictates how much they can spend.
Right. Lower interest rates are rocket fuel for capital expenditure. If it becomes cheaper for a cloud provider to borrow money, they are going to accelerate their data center buildouts even further, which flows directly into this company's order book.
Okay, we've covered a vast amount of ground today. Let's get to the lowdown. We have this profound tension playing out in real time. On one side, their position in the tech ecosystem is almost undeniable. They are a dominant, highly profitable infrastructure play with unprecedented revenue growth, custom-built AI networking technology, and a fortress-like balance sheet.
A true powerhouse.
On the other side, you have the harsh reality of short-term market mechanics. A brutal post-earnings sell-off fueled by sky-high derivatives expectations, coupled with the ever-present structural danger of having your entire business heavily concentrated in the hands of just a few colossal cloud customers.
It truly is the ultimate test of an investor's time horizon. If your perspective is limited to the next week or two, the volatility stemming from that customer concentration in the options market is very real and very sharp.
Very sharp.
But if you expand your timeline to match the multi-year reality of the global AI physical build-out, the fundamentals point to a company that has successfully made itself absolutely essential to the future architecture of the Internet.
Which leaves us with this final thought for you to take away and mull over today. With a multi-year backlog securing their immediate future, is Ciena's new Vesta 200 the ultimate golden ticket that makes them the undisputed, irreplaceable backbone of the AI revolution? Or does their heavy reliance on a handful of hyperscalers make them dangerously vulnerable if big tech suddenly tightens its belt? Think on that. Make sure you subscribe to the Easy Money Show so you never miss an episode, and hit that like button to help us keep simplifying the market for you. Thanks for joining us, and we will catch you on the next one.